A few days ago, the Bank of England quietly released its latest financial stability report. At first glance, it didn't make headlines. There were no flashing warnings, no dramatic alerts, no sense of immediate panic. If you glanced at it and moved on, you might have thought everything was fine. But hidden within that report is a message that is deeply important, and if you ignore it, you could be caught off guard. The bank is signaling, in the most measured language possible, that the UK financial system is under pressure, that multiple risks are building simultaneously, and that these risks could intersect in ways that create serious disruption. For years, interest rates were incredibly low. Households borrowed heavily, thinking low rates would last for the long term. Many people assumed that even if rates rose, the change would be gradual and manageable. But reality has a way of catching up. Fixed-rate mortgage periods are ending, and millions of households are now facing dramatically higher monthly payments. At the same time, the commercial property market is quietly under stress. Offices, retail spaces, and industrial buildings were all valued at levels that assumed full occupancy and stable demand. But remote work didn't disappear after the pandemic, and many companies are operating with fewer staff in the office than ever before. Rental income is down and property values have fallen, in some cases sharply. This isn't just an accounting detail, it has real consequences. Banks lent heavily against these properties when they were valued higher. If property owners can't meet their mortgage obligations, banks start taking losses. And once banks face losses on these loans, they naturally become more cautious, tightening lending standards. This makes it harder for businesses to borrow money, even if they are fundamentally sound. Cash flow problems appear, companies struggle to operate, jobs are lost, and the negative spiral intensifies. The UK is also highly connected to the global financial system. Problems in the United States, Europe, or Asia can reach the UK quickly, sometimes in a matter of days. The Bank of England isn't too concerned with hypotheticals. They are watching these global markets closely and recognize that any one of several international stress points could quickly impact UK banks. When the report mentions that risks could materialize simultaneously, what it really means is that multiple things could go wrong at the same time, and the central bank may have limited ability to respond effectively. Unlike 2008, when interest rates were near zero and central banks had room to flood the system with liquidity, today the options are limited. Interest rates are already above 4%, inflation is still elevated, and central bank balance sheets are enormous. Deploying further interventions could damage credibility and may not be as effective as in previous crises. It's crucial to understand that the bank's warnings are not meant to incite panic. They are meant to create awareness and allow institutions, investors, and households to prepare before problems become unmanageable. Those who are aware are already taking action. Large institutional investors are reducing exposure to UK assets, holding more cash than usual, shortening bond durations, and purchasing protection against potential defaults. These are not hasty reactions, they are calculated steps to reduce risk and retain flexibility in uncertain times. For individuals, preparation is similarly about positioning rather than panic. The first step is to build a solid emergency fund. If you don't have at least 6 months of expenses set aside, that should be a priority. Cut back on discretionary spending and redirect that money to build a buffer. This fund isn't about earning interest, it's about survival and flexibility. When the financial system is under stress, the ability to meet your obligations without selling assets at a loss is more valuable than any return you could earn on investments. Reducing variable rate debt is another critical step. Credit cards, personal loans, and mortgages with variable or tracker rates become extremely expensive when rates rise. Fixing rates where possible or paying down these debts can prevent a sudden spike in expenses that could destabilize your finances. Diversifying your investments beyond UK assets is also important. If your entire portfolio is tied to UK property, UK stocks, and UK bonds, you are concentrated in exactly the sectors and markets the bank is warning could underperform. By holding internationally diversified funds, you spread risk and reduce the likelihood that one local shock will devastate your finances. It's also vital to stress test your personal finances. Ask yourself tough questions. What happens if your mortgage payments double? If property prices drop by 20%? If your investments lose a third of their value? If you were to lose your primary source of income, could you survive 6 months or more? Identifying vulnerabilities before a crisis gives you time to address them. Maybe it means saving more, reducing debt, changing your investment mix, or even acquiring skills that increase employability. Another step is to consider income diversification. Relying solely on one employer or one source of income is risky, especially in sectors vulnerable to economic shocks. Developing additional income streams, freelancing, part-time work, side businesses, or investments creates a buffer. Even partial income replacement can make a huge difference during periods of financial stress. Liquidity and flexibility are equally important. Don't lock all your money in long-term investments, illiquid property, or assets that are difficult to sell quickly. In times of stress, the ability to move money where it is needed most can be far more valuable than the small returns you might earn from keeping it locked away. Options and adaptability are what separate those who survive financial stress from those who struggle. The key point is that nobody can predict exactly when or if a crisis will occur. Financial markets are complex, and timing is unpredictable. But the Bank of England's warnings are clear. The next 12 to 24 months represent a period of elevated risk. Mortgage refinancing shocks, ongoing commercial property stress, and global financial vulnerabilities could all converge. The bank is signaling that probability is elevated. Not certainty, but probability matters when planning ahead. Even small steps taken now can have an enormous impact. Building savings, reducing debt, diversifying assets, and maintaining flexibility doesn't guarantee safety, but it gives you options and control. When crises hit, those who are prepared rarely panic. They act calmly, make rational decisions, and have the resources to navigate uncertainty. Those who wait until headlines scream crisis often have very few choices left. In the end, the Bank of England is sending a simple but urgent message. The system is not immune, vulnerabilities exist, and multiple risks could collide in the near future. Sophisticated investors are positioning quietly, using cash and hedging strategies to protect themselves. Households that are proactive, disciplined, and thoughtful about risk can also protect themselves, and even take advantage of opportunities that arise in periods of stress. The question isn't to whether something will happen, it's whether you'll take action while there is still time. Preparation costs little if nothing goes wrong. But if stress turns into real disruption, preparation is what separates control from chaos, calm from panic, and options from helplessness. Being alert, understanding risk, and making deliberate choices now can make all the difference in the months and years ahead.